I'm Owen Bigland. This is the Inside Edge video blog. Okay, it's Saturday. I want to share with you guys a really good little investment letter that I picked up off BNN here. And this is by one of their stock analysts or money managers that they bring on from time to time on BNN. And I thought it was just a really good synopsis of how stocks work. Because a lot of people, and how investing works, not speculating or trading, investing, which is what you guys should be doing, not speculating or trading or gambling. And I thought he did a really good job with this cover letter here, kind of on what investing is all about, and knowing the companies that you own and what they do, how they make their money. Because so many people look at the stock market, I've talked about it in my book, as some sort of enigma, like a black hole. They think it's a casino. They see numbers up and down scrolling across the screen. Well, what they don't realize is that, you're buying companies, you own these companies. You participate in their profits. For instance, if you buy a share of Macdonald's, you are a owner now of Macdonald's. A lot of people say, "Oh, do you own any businesses, other than real estate?" Yeah, I own businesses. I own about 40 of them. They're surprised. And I rattle off, I own Apple and Amazon and Facebook and Home Depot and Visa and Costco and Johnson & Johnson and TD and Royal Bank and Coca-Cola and Pepsi and Procter & Gamble, Colgate, McCormick, Estee Lauder. I own all of them. McDonald's. When you buy a share of McDonald's, you are participating in McDonald's profits. You own a little bit of their real estate, because McDonald's, if you've read my book, McDonald's is an incredible company. They're really a real estate company disguised as a hamburger joint. You own, one 100th millionth of their real estate. You participate in every burger, every French fry, every milkshake that's sold, and every franchise fee collected. That's what you own when you're buying McDonald's. It's not just some enigma that goes up and down. And a lot of people get that confused. They think, the stock market is like is equivalent to going to Las Vegas. But let me read you this little cover letter here on how real estate, or how the stock market really works. Because, these guys are always getting bombarded with, stocks are overvalued, buy this, sell that. This guy, his name is John O'Connell, by the way, and I like this guy. He's been in the business probably for 30 or 35 years. There's a few people: John O'Connell, Barry Schwartz, David Baskin. Those are three of my favorites. I've got a couple other guys on there that I pay attention to as well. Some of the guys that come on BNN are more into trading. They're speculators. They're buying small, penny stocks, flipping stocks. They'll give recommendations on stock without knowing the person's financial situation. For instance, somebody might say, "I'm thinking about buying BCE," and they'll say, "Oh, I wouldn't buy BCE." Well, if it depends on what they call suitability. If a guy was 20 years old and looking for some stodgy stocks like a BCE, which pays a solid dividend, maybe you'd be better going into some more growth-oriented names like a Visa or a Home Depot or a Costco, that pay a much smaller dividend, but they have the growth potential there, because the guy's 20 years old and has a 50-year runway. If a guy, though, is 78 years old and looking to preserve capital, then BCE is mandatory for that guy. It's going to pay him 5%. Sure, he's not going to make a whole lot of capital gain on it, but that's not what it's about. So you can't just willy-nilly start selecting stocks without knowing the person's situation. But let me just read this to you. There are no changes to our long-term positive outlook for the companies in which we have chosen for our clients. As always, there are company-specific issues that must be navigated, but the general economic backdrop for continued global recovery continues to be a positive tailwind. That having been said, the potential for a setback in market valuations is rising. The laundry list of boogeymen under the bed is always long. Mostly we think it is irrelevant. I agree. Reading the Globe and Mail on your Google browser or scanning Facebook, you see a friend fixed up their kitchen and feel you should do something too. You go to Home Depot, buy a Stanley Black & Decker drill, or buy a new iPad using your Visa card. FedEx delivers it. Watching Disney on your iPad, you order McDonald's. McDonald's employees are wearing uniforms and washing their hands with sanitizer made by Cintas. JP Morgan, Bank of America, Citibank all provide loans to Cintas. Cintas hires Accenture to integrate the business. Cintas buys COVID testing equipment from Thermo Fisher and adds United Health benefits for new employees so they can get a new hip from Stryker. Stryker uses Rockwell Automation robotics to make the hips in a clean environment. The stock market will do what it does. Governments will do what they do. The press will interview experts like me to try and make sense of it all. The companies you own will ignore it all and go about their daily business. Are stocks overvalued? Question mark. There are lots of stocks in the world. We own amongst the best in the world, and they are doing just fine and will for a long time to come. This is how you should look at investing for retirement, for retiring early, maybe for buying a house in 5 or 10 years, saving for the down payment. This is what getting your money working for you is all about. It's not a casino here, trading GameStop and AMC and, for some people, Bitcoin. Nothing wrong with those. If you guys want to put a little mad money into those things, I am very happy for those people that have made that money in Bitcoin and AMC and GameStop. It's great. Not the type of companies I invest in, but hey, if you want to put a bit of mad money into those things, by all means go for it, and I hope you make money. I love to see it. I'm loving to see these small retail investors skating circles around some of these big money managers, which has been happening, and these short squeezes and everything else. I love it. I've been saying it for years. Start empowering the individual investor, and these commission-free trading platforms are doing that. Just be careful though. If you're going to buy those type of companies, just make sure it's a very small portion of your mad money. Have your foundation in stocks like this. And I probably own at least half of the companies listed off here. JP Morgan, FedEx, Visa, McDonald's, Stryker I own. Stryker's an incredible company. I probably own half the companies these listed there. And I don't lose any sleep holding them. You know, there are going to be good days and bad days with them, but when you take these stocks out over the next 20 or 30 years, you are going to make boatloads of money. Because that's how these companies work. You know, companies are going to continue, McDonald's is going to continue to sell hamburgers and French fries. They're going to continue to franchise new restaurants. There's always going to be tailwinds. I'll give you just a quick story with McDonald's. I've owned McDonald's probably for 18 years now. Probably up 400 or 500% on it, plus those fat dividends I keep collecting. McDonald's has had some great years and some bad years. When I first started buying McDonald's, it had a CEO by the name of Skinner, and he was an incredible CEO. I think he had a military background, ran McDonald's like a Swiss watch. Skinner retired, and they had a new CEO that came in by the name of Johnson. And he was not a sales guy. He was not a restaurant guy. He moved his way up the corporate ladder into McDonald's. And he was a terrible CEO. Absolutely horrid. McDonald's was driven into the ground. The franchisees did not like him. He made a lot of changes. McDonald's stock was basically, almost, from what I remember, probably cut close in half at that time. Luckily, they ousted him. It's like Warren Buffett says, you know, you buy companies that are so profitable, you know, a ham sandwich could run it, because a ham sandwich eventually will run it. Well, Johnson was the ham sandwich. But McDonald's is too smart. Their board of directors aren't going to keep those guys around very long. He was ousted. They got in a new guy by the name of Steve Easterbrook. Easterbrook turned the company around. McDonald's doubled from that point on. Unfortunately now, Easterbrook about 2 years ago had to leave. Won't get into it, but you know, was having some sort of an affair with one of the employees at head office. You can read about it in Wall Street Journal if you want to look up his name. But McDonald's, what I'm saying here, has had some incredibly good years, and then they've always, sometimes a lot of these good companies fall on hard times. Shouldn't bother you unless McDonald's said, hey, we're not going to sell hamburgers and milkshakes anymore, and we're going to go into the bicycle business. Then I would probably sell my shares. But use those dips which all good companies, most good companies go through as good buying opportunities to top up more shares. That's what I was doing. But I really like this letter of what he was saying here. The last thing, he was talking to, and I've been reading a lot of articles in Barron's and Wall Street Journal, on suitability, which I talked about. A stock that might be suitable for a 70-year-old might not be all that great for a 20-year-old. It all depends on where you are in life, what your income, your age, your risk tolerance. But, I've been reading a lot of articles now, on fixed income and bonds, which, as people know, are not paying you anything. Fixed income is paying you 0.5%. Bonds are at 1.5%. Inflation is rising. Inflation's running now at 3.5%, 4%. So you're losing money in fixed income right now. And it's like a double-edged sword. Unfortunately, people that do not have enough money for retirement need to preserve the little that they do have and need to go into fixed income and bonds. But it's like putting the final nail in your coffin. You're going from equities, which might in the long term return 7 or 8%, and maybe of that 4 or 5% will be guaranteed in the form of a dividend. You're going down to a fixed income at 1%, and inflation is running at 3.5%. So you're losing 2.5% on it. Plus, those bonds and fixed income are not very tax efficient. So it's a real trap that people get into, and it's why I talk about it in my book. My strategy has always been to build a big enough portfolio that you never, and it's my portfolio, by the way, is 100% in equities. I do not own any fixed income or bonds, and I never will, ever. The reason is that I've supercharged or bulletproofed my portfolio. I don't have to go to fixed income because I've created a big enough portfolio that spins off enough cash that I don't even have to sell shares. I can just live off the dividends flow. And in the back of my book, and I've tweeted out lots of stuff to some of these websites, including a site like Canadian Couch Potato, that you can start creating these portfolios. You got to start when you're young. It's never too late. But try and create a portfolio that will produce, equity portfolio, that will produce dividends and cash flows. So you don't have to go into these fixed income bonds, which is just, again, putting the final nail in your coffin, as they say. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.